Okay students, so the next concept will be accounting period concept. Accounting period concept. Okay, so what is an accounting period? It refers to the span of time at the end of which the financial statements of an enterprise are prepared. To know whether it has earned profits or has incurred losses during that period, and what exactly is the position of its assets and liabilities at the end of that period. Okay, so now you have to understand this. Okay, it's very simple. I'm just talking about, let me just tell you, okay, there's nothing complex. I'm just talking about 1st Jan. Why do we prepare financial statements from 1st Jan to 31st December? Simple. Okay, do you have question regarding this? Do you have ever asked your teacher why do we start our business from 1st January and it ends in 31st December? No, right? Because it's very simple. But what I want you guys to understand is, let's understand simple things, okay, in a better way, okay, so that it gets into our subconscious mind. Okay, so see, you have to understand, for every business, okay, it is important to know whether they have earned profit or losses. Okay, so see, what is the main concept, what is the reason behind preparing financial statements? Okay, so here, financial statements, what do I mean by financial statements? It means profit and loss account and balance sheet. Okay, so what is the main reason behind preparing profit and loss account? To ascertain the net profit or net losses, right? We have to know, right? We want to know what is the net profit we have earned, what is the net, or what is the net loss which we have incurred. Okay, so earlier it was a very problematic thing. Okay, some were preparing financial statements from Jan to December, other was preparing from Feb to Jan. Okay, another guy was preparing from March to April. Okay, so the government came up with a solution. Okay, the government came up with a solution, and the government has fixed that all will follow one accounting period. All will follow one accounting period. Okay, all will follow one accounting period. So now they've prepared P&L account to find out the profit or loss, right? Now they'll have to prepare balance sheet. Why do they prepare balance sheet? What is the main reason behind preparing balance sheet? Okay, they want to know, okay, the financial position of the business. Okay, they want to know how much assets they have and how many liabilities they have. Okay, this is the simple reason behind preparing financial statements. Okay, now do you think it is possible for a businessman to evaluate the financial statements every day? Okay, is it possible? No, right? Is it possible to evaluate the financial statements every month? No. Every week? No, right? So in general, every businessman evaluate this in a year. Okay, they evaluate means they prepare, every business will prepare the financial statements once in a year. Okay, and this span of time is called as accounting period. Simple as that. Okay, now in class 11 you have the accounting period which you normally follow when you solve the question was 1st Jan to 31st December, right? We also call this as calendar year. Okay, calendar year. But in real world, okay, I've never seen, let me be very frank with you. Okay, I've never seen any businessman following calendar year. Okay, I've never seen a businessman starting his books of accounts from 1st Jan and ending it on 31st December. Okay, because see, 1 year is equal to 12 months. Okay, so you have to prepare, you have to start your books from 1st Jan and end it on 31st December. Okay, now this is according to your books. Okay, this is according to your books. There are many questions. Let me be frank, I've not seen I may be wrong. Okay, I've not seen a single questions on financial, like following financial year. Okay, I've never seen any question following financial year. There may be questions, but the way I remember is I've not seen a single question on financial year. Okay, so now in real world we follow financial, in practical terms we follow financial year. Okay, we call it financial year. Now this financial will start from 1st of April and it will end on 31st March. Okay, so see, we will open our books of account, on on 1st April and end it on 31st March. Okay, open the books of account 1st April and end it on 31st March. Okay, now many students used to have problem, okay, to remember this 1st April and 31st March. Okay, this part many students used to face problem. Now how will you remember this? Financial year will start from 1st April and it will end on 31st March. Okay, so A is the first letter of the alphabet, right? A is the first letter of the alphabet, right? So a financial year will start from April. Okay, see, the first letter is A. Okay, so you can remember this way. But in your question, maximum question, you will use calendar year as your accounting period. Okay, which means 1st Jan to 31st December. Now when this period comes, 31st December, you will prepare your profit and loss account, okay, trading account and your balance sheet. Do you know the reason why we prepare these accounts? Basically profit and loss account and balance sheet, simply because we want to know the profit we have earned or the losses we have incurred, right? Obviously, what is the main reason behind running the business? Profit motive, right? If you are not running an NGO, if you are running a normal business, the basic motive of running a business will be profit, right? To earn profit. So by preparing profit and loss account, what is the main reason of preparing? What is the final conclusion of profit and loss account? To calculate the net profit, right? So the main reason behind preparing profit and loss account is to ascertain the net profit or net losses. Simple. Now why do we prepare balance sheet? Why do we prepare balance sheet at the end of every year? See, balance sheet will have liabilities, will have amount, assets, amount, right? You will have your capital, you will have your current liabilities, creditors, you will have your loans, and many other bills payable, etc. Okay, here you will have your fixed assets, here you will have your current assets will have debtors, inventories, okay, cash, bank, bills receivable, right? Why do we prepare balance sheet at the end of every year? What's the main reason behind preparing balance sheet at the end of every year? Do you know the reason? To know the financial position of the company. Simple as that. Okay, say for example you are running a business. Now you are in need of fund. You want to get a loan from the bank. Okay, the first thing the bank will ask you is your financial statements, your profit and loss account and balance sheet, because if you are a loss making entity, okay, bank will also be hesitant to give you loan because you are not earning a profit. How the bank will question how will you pay the interest amount or the principal amount. Okay, now even if you are incurring losses, the next thing they will see is your balance sheet. Okay, if your financial position is very good, say for example you have a good fixed assets, okay, fixed assets, you have good like debtors, you have to receive money, you have good bills receivable where you have to receive money. Okay, so bank will see all these things. Okay, how much cash you have in your account, how much bank balance you have, right? What is the investment, your inventory investment you have done, right? All these things the bank will analyze and the bank will give you loan. Okay, so basically profit and loss account and balance sheet we basically prepared for the users of the financial statements. Okay, now who is the users of the financial statement? It can be your creditor, it can be bank, okay, it can be government, right? So this is the reason why we prepare P&L account and balance sheet every year. Okay, now a fixed accounting period has been set, okay, so that it is easy for everyone to evaluate things. Okay, on a if you are to evaluate balance sheet of two companies, okay, if the accounting period is different, okay, how will you analyze between these two balance sheet? Okay, so everybody should follow one accounting period. Okay, normally in real world we follow it from 1st April. We open the books on 1st April and close it on 31st March. Okay, now is it mandatory to prepare books of accounts only once in a year? Can we prepare it twice? Can we prepare it thrice? Yes. Okay, there's no problem with that. You can prepare your financial statements on monthly basis, quarterly basis, okay, and half yearly basis or yearly basis. Okay, there's no problem with that. 1 month you have understood. Quarterly simply means 1 quarter has 3 months, okay, and 6 months 12 months. Okay, if you want you can prepare your balance sheet, your financial statements every month, once in 3 months, once in 6 months, or once in 12 months. Completely depends upon you. Okay, now basically 3 quarterly and this half yearly balance sheet is prepared by listed companies. Okay, I'll not explain what listed companies is. If you want to understand in short, these are the companies which are listed in the stock market. Okay, if you know what stock market is. Okay, now this is not that much important as of now. I'll discuss this later, okay, when we actually take the classes. So it is possible, right? If anyone asks you can we prepare balance sheet more than once a year, your answer should not be no. Okay, your answer should always be yes. Okay, it completely depends upon the entity. Okay, they can prepare once in a month, twice, once in 3 months, once in 6 months, or once in 12 months. Okay, so this was all about accounting period concept. See, these things are very simple. Okay, I can simply say that one accounting period is equal one accounting period is equal to 12 months. Okay, from 1st Jan to 31st December. I can simply say and finish the topic. But what I personally think is having conceptual clarity is very important. Okay, these things I came to know, I got to know all these things. Why we prepare P&L account, what is the main reason behind preparing P&L account, why do we prepare balance sheet, okay, and what are the accounting period, why accounting period is fixed for 12 months, right? These all things I literally had no idea when I was in class 11 or 12. I had no idea when I was in class 11 12. I got to know once I started my CA career, pursuing CA. Okay, so you are, I guess, I don't want to praise myself, but I guess you are quite lucky enough, that you are at this level. Okay, you are being able to analyze things in a better way. Okay, see, there are many teachers. Okay, I'll not blame anyone, and I'll not say any bad thing about any teacher, because every teacher, they are teacher for a reason, right? But many teachers will say that this concept, you don't need this concept right now. You'll be learning this in your college days. Okay, you'll be learning this on your college days. Now when you go to your college, you know what your college professor will say, that you have learned this topic in class 11 and 12, so I'll not cover this topic. Okay, so with this what will happen is, you have not learned a particular topic when you were class 11 and 12. Now the same topic when you went to the college, in a hope that you will learn when you go to college, the professor says that you will learn in your 11 and 12. Okay, so students usually face this problem. I have even personally faced this problem. So it's better to go deep and analyze things in a better way and try to understand things in a better way. So this was all about account. Next thing we'll talk about is opening stock and closing stock. Okay, opening stock and closing stock. So what is an opening stock? What is an opening stock? It is the stock available with the firm on the opening day of the accounting period. It may also be termed as stock at the beginning of the year. Okay, so next will be closing stock. What is closing stock? It is the stock available with the firm on the closing day of the accounting period. Okay, it may also be termed as stock at the end of the year. Simple. Okay, simple. Now what is an opening stock, what is a closing stock? See, this is the beginning of the year, opening period, opening day of the accounting period, to the 1st January, right? And this is the closing day, 31st December, right? Now whatever stock you have at this point will be called your opening stock. Simple. So for example, you are in the business of selling mobile phones. Okay, you buy mobile from the wholesaler and you sell it to the end customer. Okay, so what is your what is the item you deal in is mobile phones. Okay, so what will be the number of mobile phones you have at the opening of accounting period? That will be called as opening stock. Okay, now whatever you have purchased during this period will be called your purchases. Okay, and at this point whatever number of phones you are left with will be called your closing stock. Now when we come to the next accounting period, this closing stock will be your opening stock for the current year. Okay, or you can just say it will be your opening stock in the current year. Okay, because the end of a financial year is 31st December, accounting year 31st December, and the very next day is 1st January. Okay, so if you close your books of accounts here, okay, you will open it in the very next day, so the closing stock will be your opening stock. Okay, simple as that. Now the next point which we will talk about is debtor. Okay, debtors. Don't call it debtor, it's not debtor, it's debtors. Okay, now who is a debtor? The term debtors represents the person or parties who have purchased goods on credit from us and have not paid for the goods sold to them. Okay, I have explained that sale is of two type, cash and credit, right? Cash sale simply means you buy goods, a person buys goods from you and he pays you money immediately. Okay, now credit sale is you sell goods to a person and he did not pay you money. Okay, he purchased goods on credit. I hope you are clear with this cash and credit sales. Okay, now the person to whom you have sold the goods, he will be called your debtors. Okay, I will repeat it again. The person to whom you have sold goods on credit will be called your debtor. Simple as that. Okay, the person to whom you have sold goods on credit will be called your debtor. Okay, now where will you show this item in your balance sheet? Okay, see, debtor is a current asset. I hope you know that debtor is a current asset because the amount the sales amount which we have sold on credit, okay, which we have not yet received the money, we will receive it before 12 months. Okay, current asset because we will receive the money, receive the amount within 12 months. So it will be called our current assets. Okay, now when you make your balance sheet, this is your balance sheet, this is your liability side, this is your asset side. Okay, here will your fixed assets will come here. Now debtor is a current asset, so current asset account debtors. Okay, so should I repeat it again? Who is a debtor? The person to whom you have sold goods on credit will be called your debtor. Now the next topic which we will cover is bad debts. Okay, what is a bad debt? Very simple. See, let's understand this with an example. Okay, this is you, Mr. Seller, and this is your friend Mr. Buyer. This is your friend Mr. Buyer. Okay, now Mr. Seller, you have sold goods to Mr. Buyer on credit. Okay, sold goods to Mr. Buyer on credit. Okay, now Mr. Buyer had agreed to pay the money. Let's say the amount was 10,000. Okay, Mr. Buyer agreed to pay the money within 30 days. Okay, now when the payment day occurred, okay, when the payment date occurred, Mr. Buyer could only pay rupees 9,500 to Mr. Seller. Okay, because Mr. Buyer became insolvent. Now what do I mean by insolvent? What's the meaning of insolvent? Insolvent simply means Mr. Buyer was left with no money. Okay, he became bankrupt. If you want to understand what's bankrupt, you can simply Google it. You'll get the definition of bankrupt. Okay, bankrupt simply means the court has ordered that you are left with no money. Okay, if you have to pay anyone, if you have taken any loan, or if you have any obligation, you won't be able to pay any amount. Okay, you are bankrupt. Now see, in this case what has happened, that Mr. Seller sold goods to Mr. Buyer on credit. Okay, and the amount which Mr. Buyer had to pay Mr. Seller was rupees 10,000. Okay, now when the payment day occurred, Mr. Buyer could only pay how much? Mr. Buyer could only pay 9,500. Could only pay 9,500, but Mr. Seller had to receive how much? 10,000. So what is the bad debt amount in this case? 500 rupees. How? He had to receive 10,000, but he could receive only 9,500. Okay, so can I say this bad debt is a loss for Mr. Seller? Is a loss for Mr. Seller. Okay, is a loss for Mr. Seller. Now how will he record this in his books of accounts? When he prepares his P&L account, he will debit the bad debts in the debit side. Okay, debit side is for all expenses and losses. Now he will debit this 500 in his debit side. Okay, he will recognize the loss in the books. Okay, this is the treatment of bad debts in your P&L account. Okay, now let's go back to debtors. Okay, let's go back to debtor. How will you record this data in your books of accounts? When you prepare your balance sheet, okay, this will be your fixed asset, this will be your current asset. Under current assets you will record your data. Okay, I hope the concept of bad debts and debtors is clear to you. Okay, so now the next concept which we will cover here is creditors. Okay, students used to have, students used to be very confused between debtor and creditor. Okay, don't be very confused between debtor and creditor. It's very simple. You just have to understand, you just have to think it logically, that's all. Okay, now let's talk about creditor. Okay, now let's again understand this with an example. Okay, or before that, can I simply say who is a creditor? Okay, now again you have to think it from the point of view of you have to assume that you are the business owner. Okay, you have to assume that you are the business owner, you are the one carrying on the business. Okay, can I simply say a creditor is a person? Again, this person can be individual person, this person can be business entity, this person can be government body. Okay, a creditor is a person from whom we have purchased goods on credit. Simple. Who was a debtor? Debtor was a person to whom we have sold the goods. Now creditor is a person from whom we have purchased goods on credit. Okay, now so for example, this is a person. Okay, Mr. X. Okay, and this is you, Mr. Y. Now you have a business. Okay, you have a business. Now you go to Mr. X. Okay, you go to Mr. X and you purchased the required items from Mr. X on credit. Okay, purchased on credit. Now see, again when I explain purchases, there was two types of purchases, cash and credit. Okay, when you do cash purchases, what was the meaning of cash purchases? You buy things, you buy goods, you pay the money instantly. Okay, transaction is completed. In case of credit purchase, you go to the supplier, Mr. X, you buy the goods. Okay, the goods came okay, in your business premises, but you have not made the payment for that. Now in the near future you will have to make payment for that, right? Mr. X will not give you the goods which you have purchased on free, right? He will not give you. You will have to actually pay him, make the payment after some days. Okay, so this guy Mr. X will be called your creditor. Simple as that. Okay, so creditor is a liability. Again, think from your point of view. Okay, as a business owner, creditor is a liability to you. What do I mean by liability? You will have to make the payment in the near future. Okay, so he's a liability to you. Okay, now how will you record this in your balance sheet? How will you record this in your balance sheet? This is your balance sheet. This is your liabilities amount, assets amount. Okay, here under current liabilities, you will record it as creditors. Okay, now you have to be very careful. Okay, if the question has given you the name of the creditor, okay, in this case Mr. X, okay, you will have to mention Mr. X instead of creditor. You will have to mention Mr. X. Okay, now this concept will be clear when we'll cover the journal entry part. Okay, as of now you just have to understand that what is a creditor. Okay, now why did I say this is a current liabilities? What do I mean by current liability? The payment will be done within 12 months. Okay, so this will be called our current liabilities. Simple. I hope creditor is very clear to you. Don't be confused. Okay, if I have to sum up between debtors and creditors, who is a debtor? The person to whom we have sold goods on credit. Okay, now who is a creditor? The person from whom we have purchased goods on credit. Okay, basic differences. Debtor is a person to whom we have sold goods, and creditor is a person from whom we have purchased goods. Okay, students, we have discussed what is bad debtors, what is bad debts. Now we will be discussing provision for bad and doubtful debts. Okay, provision for bad and doubtful debts. Okay, this is very important concept. Okay, I will request you to, if you are not sitting with a pen and a pencil, I would request you to sit with pen and pencil and note this down. Okay, now let's see. It has been the experience of businessmen that certain amount out of the entire amount of debtors will definitely prove to be bad. Okay, amount may remain irrecoverable due to the dishonesty or unsound financial position of the debtors, right? In the previous example of bad debts, I've told you that there will be bad debts only due to, I've not said only due to, but I have said due to insolvency of the debtor, right? But that's just an example, okay? There may be any other reason, okay? The debtor may willingly not pay the money, or he may be insolvent, okay? Unsound financial, he may have unsound financial position, simply means he will be insolvent, or he may not pay due to dishonesty, okay? Any may the case may be anything, okay? I've just given an example to make you understand in a better way, okay? Now let's write it further. Now in such circumstances, it is advisable to firms that they should make certain provisions out of the profit and loss account of the current year. Okay, I'll explain you in detail what is this. So that the next year may not suffer the loss of bad debts relating to the current year. Okay, it is possible that current year's debtor may prove to be bad in the next year. Okay, decision regarding maintenance for provisions of bad and doubtful debt is taken at the end of year, so it is an item from adjustment. It is an item from adjustment. Okay, in the previous example I have give you the example of Mr. Buyer and Mr. Seller and Mr. Buyer, right? Now I just give you an example so that you can understand in a better way. Okay, I've just specifically mentioned there will be Mr. Buyer and Mr. Seller. Now, do you think there will be only one person who buys good on credit, or from whom you buy goods on credit? No, there will be n number. Okay, there may be n number of customers who will buy goods on credit from you, and there may be n number of suppliers from whom you will purchase goods on credit. Okay, now see, in case of I hope you have complete understanding of what bad debts is, right? Bad debts will occur when we'll record bad debts, loss from bad debts only when the event has occurred, right? Now let's try to read this provision for bad debts once. Okay, what is a provision for bad debts? It has been the experience of businessmen that certain amount out of the entire amount of debtors will definitely prove to be bad. Okay, it has been experienced, okay, that out of 10, 2% will not pay the full amount, or they will not pay the amount which for which they have taken the goods on credit. Okay, now amount may remain irrecoverable due to dishonesty or unsound financial position of the debtor. In such circumstances, it is advisable to firms that they should make certain provisions out of the profit or losses for the current year, so that the next year may not suffer the losses of bad debts relating to the current year. Okay, it is possible that current year debtors may prove to be bad in the next year. Decision regarding maintenance of for provision of bad and doubtful debts is taken at the end of year, so it is an item of for adjustment. Okay, now see, let's try to understand this with an example. Okay, let's try to understand this with an example. Say for example, your accounting period is 1st Jan to 31st December. Okay, now this is your timeline. Okay, this is Jan. Okay, this is November. Okay, and this is your year end, 31st December. Now at this point, okay, at this point on 30th November, you sold goods to Mr. X on credit. Okay, again 10,000. Let's take the example. Sold goods on credit to Mr. X, 10,000. Okay, now the credit term, Mr. X agreed to pay the amount within 40 days. Okay, let's say he agreed to pay the amount within 40 days. Okay, now when will he be liable to pay the amount? After the year ends. After the year ends, December has 31 days. Okay, and 9. So he'll be liable to pay on 9th Jan of the next year, next accounting period. Right, now at this point, say for example, at this point, okay, at this point, Mr. Seller, say for example, your name is Mr. Y. Okay, Mr. Y, who is the seller, and Mr. X is the buyer. Okay, now Mr. Y has a doubt. See, doubtful debts. The name itself tells us that provision for bad and doubtful debts. Okay, Mr. Y has a doubt that Mr. Y has a doubt that Mr. X will not be able to pay the full amount of 10,000 rupees. Okay, Mr. Y has a doubt. It may be any reason. Maybe he has someone has told him that Mr. X will be bankrupt, or Mr. X is not a good person. Okay, he has to take things on credit and he will not pay you back the money. Okay, there may be any reason. Now, according to the concept of prudence, okay, there is a concept of prudence. According to the concept of prudence, okay, it is always advisable to make provision for bad and doubtful debts. Now let me tell you a rule. Okay, we can book or recognize anticipated losses, or we can also say future losses. Okay, if we have a hint, or if we know that we'll incur loss in future, we can book that in the current year itself. Okay, but in case of we cannot book what future profits. Okay, we cannot book this profit. Okay, only in case of loss. Now see, he sold goods on this current accounting period. Now the payment, when will he receive the payment for this, the goods which he has sold on current accounting period? He will receive the payment in the next accounting period, right? Because the payment term is 40 days. Now Mr. Y has a doubt that he will not receive the full amount. Okay, now at this point, at year end, he will create what? Provision for bad debts. Okay, provision is for bad debts is created for, see, this should be created. It is advisable to firms that they should make certain provisions out of the profit and loss account of current year, so that the next year may not suffer the loss of bad debts relating to the current year. Okay, it is possible that current year's debtor may prove to be bad in the next year. See, there is high chance that current year's debtors may prove to be bad here, in this accounting period, in the next accounting period. Okay, so if Mr. Y is in doubt, that he will not receive the full amount, he will create provision on this date, on 31st December. Okay, I hope everything is clear. Okay, I hope everything is clear. Now, what will be the journal entry? What will be the accounting treatment? What will be the accounting treatment? When he makes his profit and loss account, what will he do? Here, there was bad debts. Okay, in the previous example, now he will create two provision for bad debts. Okay, so for example, Mr. Y is in doubt that he will receive only 8,000 rupees. Okay, so the difference of 2,000 we will create provision. Okay, we will create provision. Okay, now there may not be any bad debts. I've just given the example. Okay, now don't be confused that only when there is bad debts there will be provision for bad debts. That's not the case. Okay, now I hope you have understood the concept of provision for bad debts. Right, now you may say that how will we know that this is the amount 2,000, he will not pay only 2,000, right? This is just a what we are creating provision based on our assumptions. Okay, that this much amount may be proved bad, this much amount may be bad debts in the next accounting period. Okay, next accounting period. So this completely depends on the business. Okay, the way they will analyze, the way they will analyze the situation, whether they will get the full amount or not. Okay, we will be given questions. We will be given create provision for bad debts, simple, rupees 2,000. Okay, will be given this in question. You don't have to think about anything. Okay, you'll be given straightforward in the question. You just have to create provision. Okay, here I have to debit P&L account with two provision for bad debts. Now how will we treat this in balance sheet? How will we treat this in our balance sheet? Let's say, okay, there may be two ways to treat this in our balance sheet. Okay, there is debtors. Okay, you may less here to provision for bad debts. Okay, 2,000 inside inner column. Okay, inner column. Okay, 200, 2,000, 10,000 was the amount, 2,000. So you can record it this way. Okay, or the other way you can do it, you can make your liability provision for bad debts 2,000. Okay, but forget about this. Okay, forget about this way. We'll always do it this way. Okay, that is 10,000 and provision for bad debts will be 2,000. Okay, in class 11 I guess you have prepared trial balance, right? The figure which was given in debtors, of debtors, okay, debit, credit, this is the final balance. Okay, trial balance will always give you the final balance. You don't have to less this. Okay, but if there is any adjustment, you will have to do double entry, right? That was completely different thing. Now you just have to remember that provision for bad debts will be treated this way. Okay, I hope things are clear. What is provision for bad debts? What is bad debts? Now if I have to sum up, what is bad debts? Again I will repeat, bad debts. We will, forgive me for my handwriting. Okay, I know my handwriting is very bad, literally very bad, because it's very difficult to write in this is the first time I'm recording in a tablet. Okay, so it's really difficult. So but I'm trying my best. I hope handwriting should not matter, right? If you can understand, that's the main thing. Okay, so if I say bad debts, okay, we will, I've said this 2 or 3 times. I'm repeating this again because do you know the reason why I used to repeat things 2-3 times? So that students can understand it better way, because there are students who don't understand even after explaining 3 times, right? I completely understand those type of students. Okay, so what I used to do is I used to repeat 2-3 times so that it will sink in your subconscious mind. You will never forget that. Okay, so now bad debts, we will record the loss. Bad debts is a loss. Okay, we will record the loss only when the situation occurs. Okay, when it has been proved that this is bad debts. Okay, we will not receive this amount. And provision for bad debts, when will we record? We will record based on the situations and circumstances. Okay, it will be given in question. Okay, and we will create provision for bad debts at the year end. Okay, because current year debtors may prove to be bad in the next accounting year. Simple. We have sold goods at this period, okay, during the current accounting year. Now you will receive payment next accounting year, because the payment term was 30-40 days, right? Now this year's debtors may prove to be bad in the next financial year. Okay, so this is the main concept of provision for bad debts. Simple and easy, right? If you explain, if you understand, things are very easy.